Hi friends, welcome once again. So at this point, what we are going to do is we'll recap what we've studied about intangible assets and goodwill, especially in the area of development cost. Okay, we just recap that one. There are one or two items which I want us to look at because it's quite interesting in terms of development costs. And I believe we'll get some learning points over there. So once again, I'm trying to share my screen. I hope you can see it. Okay, so stop sharing. Not too sure if I got it right, but let me try again. So sharing my screen, and I'm sure we have it now. Good. All right. Okay. So a recap of what we've studied, and then just wrap it up with one or two dimensions. So development costs. Remember the pirate criteria probability that it will bring us future economic benefits. Okay, there is always the intention to complete the project. Okay, there's resources available for us to undertake it. We have the ability to complete the project technically feasible to finish up what we've started, and then expenditures can be measured reliably. Okay, like I said, the recent ACCA text had change the R to be resources. Instead of resources available, it uses a different dimension. The E uses expected profitability, okay, and the A uses adequate um, resources, while the R is talking about reliable measurement of the expenditure. But either way, we get along with it, okay. So a range of costs, we need to include them in the cost of an intangible once they've met all of these criteria. But what are the range of costs we include? Okay, remember, not everything has to be included. So that's what we need to look at. So the material cost, the service cost, okay, if there's a consultant we used, a researcher we used, we need to measure those ones. Okay, a consultant who helped in developing it. Wages and salaries included, okay. And then we're also looking at fees to register a legal right, patent fees, legal charges, okay? And also amortization, any depreciation cost of any required patents and licenses should be included. But what should be specifically excluded in this development cost is that all selling and admin costs and expenses, overheads, indirect costs should be out. And then any staff training cost should also be eliminated. You see? So it's not a blanket tick off that once they have met the pirate criteria, we should recognize all. We should just include them. No. Make sure the ones training staff training costs are out. And then any selling and development, any selling and administrative costs or overheads are also excluded. Now, there is one odd element with the research cost. Okay. Remember, we don't recognize it, okay? So the rules about business combination produces this particular odd element. We are saying that any intangible asset um, which was not recognized by one business. For example, they did some internally generated intangible but did not meet the Paris criteria, should not be recognized by one company. However, once you acquire that company which did not recognize the intangible, you must recognize it. That's strange, right? That's very strange. So, for example, if a company A buys company B and company B has an ongoing research and development project, the rule is that company B will not recognize the research element of the project. They are still developing it, okay? They are still in the research. However, company A, upon acquiring company B, can recognize the entire cost of the research, provided we can measure it at the fair value and provided it meets the definition of an asset. Okay, you control it, it leads to future economic benefit that flows to you. You need to recognize it. Okay, that's quite odd. Okay, so there's a little bit of ambiguity over here. There's a little bit of ambiguity over here, but the rules or the criteria says that. Let's do it. Okay. So a bit there, because if you want to meet the definition of an asset, what we say is that yes, we control. Once we've acquired, we control. We have to see whether there will be reasonable profitability or probability of future economic benefit flowing to us. But remember, this is still in the research phase, okay? But it is not development currently. It hasn't gotten there. Okay, what shows that subsequently? What shows that subsequently this particular research we are recognizing will lead to some development. Okay, but that's the rule. The rule is saying that if I am developing it, I'm still researching. I shouldn't recognize it. But if you come and acquire me, you should recognize the research component once you can measure it at fair value and it meets the definition of an asset. Okay, so we have internally generated goodwill, like loyalty, customer loyalty, perception of a company cannot be recognized. Okay, in internally generated goodwill. Note carefully, internally generated goodwill also should not be recognized. But if that entity is bought, then goodwill can be recognized. Okay, so normally the reason why this is allowed is because it is assumed that the consideration, the amount you pay for the company, can easily tell whether we are acquiring it at a higher value than its fair value of identifiable net assets or not. Okay, that's why we want to recognize it. At the end of the day, it will be one of either of two, a goodwill or a bargain purchase. Okay, so because we can reliably measure the goodwill as part of the purchase cost, we are asked to recognize it once we acquire. Okay, all right. Subsequent measurement, we've mentioned cost and revaluation. Like I said, cost is simply similar to the tangible non-current asset like PPE, except that the only thing we are referring to here, we are not mentioning accumulated depreciation. We are rather mentioning what? Amortization. So that's the only thing there. Okay, physical assets will say depreciation, whereas intangible will say amortization. Now, always residual value should be assumed to be nil unless certain specific conditions pertain. I'll leave that one for you to look into it. So the residual value of the intangible should be nil unless certain specific conditions pertain. Try and look into the text and examine those ones. Again, revaluation, same basis as tangible non-current assets, okay? Except that here we need to get an active market to develop to determine the revised values, okay, the fair values that we are using. All right, anytime, and I mentioned this, we've looked at it in the previous one, anytime the intangible has an indefinite life, we cannot amortize it. Instead, we undertake impairment reviews, okay? Again, subsequent measurements, IFRS 3 allows goodwill arising from business combinations to be held at cost. If it is held at cost, there's no amortization. Instead, we subject it to impairment. So you don't want to say goodwill has been amortized. We normally will say it has been impaired, okay? And it is in line with IAS 38, which is a whole topic we'll look at along the line, okay? So all intangible assets needs impairment testing at least every year or as regularly as you can, okay, provided you think it's feasible. The process is the same as when you are doing it for tangible current assets, okay? Remember once again, IAS 38 deals with intangibles, IFRS 3 with goodwill. However, impairment of this intangible affects both IAS 38 and IFRS 3. Any impairment losses you make, you incur, write it off to the income statement. Okay, anyone, you write it off. And we looked at it the other time when we're looking at revaluation, when there is a gain, when there is a decrease, you recognize it in the income statement or in statement of comprehensive income. Otherwise, you can knock it off against the revaluation reserve, provided it is going to reverse a previous transaction you have worked on the same asset in the revaluation account. Okay, all right. So wrapping up, summary, intangible assets is if they are separable, then it's IAS 38. If it's not separable from the company, then that is goodwill, IFRS 3. Again, If intangible asset, if the IAS 38, the intangible, is internally generated, we cannot recognize it. But we can only recognize it if it meets the pirate criteria. Okay? If it is purchased off the shelf, then we can recognize it at cost. Otherwise, we could use alternative procedures, revaluation models to check if there is any definite life or indefinite. Okay. If it is indefinite, okay, if there is definite useful life, we use revaluation to check. But if it is indefinite, we look at using impairment testing to check for it. Okay. With goodwill, if we generate goodwill internally as a company, we never recognize it in the books. But if we purchase it off the shelf as a result of business combination, okay, what we have to do is we recognize it at fair value during the business acquisition or the combination phase. And again, we have to test regularly for impairment to be sure whether the value has reduced or has been the same. Okay, all right, that's it. So in summary, treatment of intangible is complex, much more complex than tangible, but the rules applied appears to be the same in both situations, both in the tangible fixed assets and the intangible. Intangibles are becoming increasingly important part of financial statements, and those of you who will venture into the field of audit, you love to audit intangibles. It's quite interesting. It opens your mind to some other things which the standard even does not cover. Within the system, you get to understand some technicalities of these development activities. Okay, goodwill in particular is also common in all mergers and acquisitions. You find it there. And we'll see more examples over the weeks when we go into it. Independent study, once again, I'll entreat you to read your core text, ACCA, any additional text from, as we know from our recommended resources. Okay, attempt to practice more questions. Read the standard on IAS 38, and I will also ask you to read the standard on IFRS 3, Goodwill, because that's the next stage we are going into. What I would say is read other documents you will find relevant from ACCA, IC, AEW, ICAS, okay, any ones, even the ones that the audit firms have issued. You'll find PwC, KPMG, EY, Deloitte issuing some good publications on these IFRS standards, okay. Read introductory slides on consolidated. Like I said, I'm going to introduce it in the next session. And then please read all the text that we find within the ACCA text. And the model handbook, quite handy. Make good use of it. All right. So I'll leave it here. Good enough, 13 minutes. And I'll see you in the next section. So sorry, it may appear a lot of information is being given to you at this time, but typically it's interesting. We want you to get engaged. The book is very big, voluminous, okay? And once you've already studied it in the previous lessons, in the previous FA1, FA2, this is just a refresher. Okay, and so you are building on you are not doing something new, you are building on previous knowledge, and it makes life quite interesting and lovely. All right, I'll see you in the next session when we look at introduction to consolidated accounts. Okay, bye.